Hello, everyone. It's Wednesday, December 7th. Welcome to the Final Bar. We're going to talk with Leslie Jouflas of Trading Live Online. We'll get her take long-term to short-term on the S&P 500 choppy session. Major averages finishing a bit lower. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. I was taught that technical analysis helps us understand investor psychology by quantifying the behavior of individual investors, as well as institutions and other different players in the market. And I feel like now more than ever, price can be a fantastic reflection of supply and demand, maybe more to the point, fear and greed, right? Those emotional drivers of investment decisions that plague many individual investors and even some institutional ones as well. Kind of a choppy session today. The last couple days, Monday and Tuesday, very much in a distribution phase with the major averages pushing to the downside. Today, sort of a digestion day. That's where we've had the big meal. We've had the Thanksgiving dinner of a sell-off, and now we're sort of digesting things and seeing things where things play out. We're going to dig a little bit into breadth indicators today. We'll talk about some of the weakness that I'm seeing in one particular indicator, the bullish percent index flashing a pretty decent sell signal today. So we have a lot of great charts to get to. A fantastic guest today, by the way. Leslie Jouflas is going to be joining us here in a little bit. Coming up the rest of this week, on Thursday, we have Frank Capillari. Frank recently launched his own firm called Cap Thesis. We'll get his take on the overall market. Wanted to let you know about a special guest we have on Monday the 12th. Jeff Hirsch is the editor of the Stock Traders Almanac. We have a special right now in the StockCharts store for the 2023 Almanac. We're going to bring Jeff on the show for a special conversation about seasonal trends going into the new year and some of the charts he'll be featuring in next year's Almanac. Next Tuesday, the 13th, we have Sean McLaughlin, option strategist at All-Star Charts. We also want to let you know about a special webcast we have coming up on Tuesday, December 13th, my latest webcast for market misbehavior called 5 Best Practices for Stops. I've been asked a lot during the course of this year how to manage risk, what sort of stops people should set when they do take long positions. We're going to spend an hour digging into 5 of the best practices I've come up with working with a lot of successful investors. Some really important lessons from 2022 and what you should be looking for as you manage risk going into the new year. You can sign up for that free event at marketmisbehavior.com/stops. Let's continue on with our show today with our market recap. As I mentioned, a bit of a digestion day is what I usually call this. And what I mean by that is you have the big move, you have the big meal, and what's pretty common in the financial markets, you have the big move, and then you sort of have the consolidation phase, sort of the digestion, whatever cause, whatever catalyst, whatever reaction that was, has now played out. Now the market kind of resets. Buyers and sellers are generally in agreement about where things are at, and that sets the stage for the next move, right? And I would say that's sort of how I would describe the action that I saw today. Now, having said that, if you look underneath the hood, there are a lot of stocks having big movements. A chart like Campbell's Soup up over 5% today. You have plenty of stocks down on the same day as well. So it's all about where the market nets out, but there have been plenty of things in the move today. And let's dig into the charts and see what sort of signals and patterns we can find. The Dow actually sort of neutral for the day, literally unchanged from yesterday's close. The S&P not too far different from that, down about 0.2%. See the NASDAQ composite down about 0.5%. So continuing to see the FANG sectors or FANG-like sectors, consumer discretionary, technology, communication services at the bottom of the list. So if you're looking for a general takeaway from today, besides the fact that it was a choppy digestion day, look at what was working today, look at what was not working. The things that are working, kind of defensive, right? Consumer staples, real estate, healthcare, the best performer today. Things that are struggling are the growth-oriented, traditionally offensive sector. So while today was a choppy, flat day, I think the signal still continues the pattern we saw so far earlier this week, which is a pattern of distribution, more of a bearish reaction from the recent sort of unwinding from the recent rally phase. You saw bonds actually rally today. The TLT was up just over 2%. Interest rates came down essentially across the board, with 10-year yields going down to just above 3.4%. We were as high as 4.25% not too long ago. We have continued to push lower. And this rally in bonds is an interesting sort of divergence from the pattern that we've seen for quite some time. The AG ETF above its 200-day moving average this week. The dollar index coming off of it by about 1/3%. That's using the UUP ETF. Commodities a bit mixed, although gold and silver had a pretty decent day. Silver price is up about just over 2%, gold just under 1%. We've talked about that sort of emergence of the gold trade. I was doing a webcast earlier this week for the Boston Investor Group. So shout out to our friends in New England. We had a great discussion, a great Q&A discussion about a bunch of different charts, a bunch of different sort of big picture themes. One of the things we talked about is if you had perfect foresight and you knew what was going to happen in 2022, and if I told you in December of last year, the markets are going to be struggling, the major indexes are going to be down 10, 20, 30%, and inflation is going to be the biggest reason why that's the case, I would say 10 times out of 10, buy gold and just go hang out somewhere for the year, and you're probably going to have a pretty decent year. Now, on a relative basis, you probably did fine with that because gold has outperformed the S&P, and it's not been close in 2022, but it's not been up to the point where you might expect. It's not really been that safe haven, and part of that, if not the reason, is because the dollar has been so strong. So the dollar coming off recently has certainly changed the configuration of this market to a pretty significant degree. And I think the big open question going into next year is, has this been a mean reversion trade of strong stocks, strong bonds, and weak dollar? Does that re-engage? We re-engage the larger trend that we've experienced for much more 2022? And does that, sort of provide the narrative for the beginning of next year? And if so, I think things could get pretty ugly pretty quickly, but we'll let the markets tell us themselves what is actually happening. Cryptocurrencies, for the most part, all in the red. Bitcoin down about 1.5%, Ether down just over 3%, with Ethereum prices getting back down toward that 1,200 level. I want to look briefly at the chart of the S&P 500. Today's guest, Leslie Jouflas, has a really good chart that I want to allow her to talk about, just to report on what's actually happening, reporting just the facts here. The S&P this week has been distributing, right? And if you look, I think that was last Wednesday, we had that big move higher. That's where we closed above the 200-day moving average for the first time since April. We traded up last Thursday right up to 4,100 and actually had a down close that day. And continuing on today, every day we've continued to close lower. So get excited when we stop closing lower. That's one thing I would tell you about thinking about the dynamics here, right? Just simply directionally, what are we doing day to day? The last 4 trading days have been relatively weak. A lot of movement, a lot of choppiness, like on a day like today, but we keep continuing to push to the downside. And I can't help but look at this larger trend of lower highs and lower lows that have really been the story of 2022, and talk about a complete opposite of the story in 2021. Back to the market dashboard here, and I'm not going to go too much into breadth because we have a segment a little later all about breadth indicators. We'll talk about some of them in particular. So I want to talk a little bit about just sector rotation here. When I had Julius de Kempener on the show last week, we were talking about the rotation away from sort of growthy offense, things like tech and communications and consumer discretionary names, more into defensive areas of the market, things like healthcare, consumer staples, and more cyclical sectors, right? Like energy, obviously, we've talked about for quite some time, but also industrials and materials. So today, you sort of look at what's on the top of the list, and it's those type of areas of the market. It's really a defensive feel to the tape today. Healthcare, the strongest sector. And if you're looking at relative strength in recent weeks, and really the last 6 to 8 weeks, healthcare has done pretty well. And it's not just been about recently, right? If you look longer term, healthcare has actually been outperforming with certain areas of the market much more than others. The growthy stuff is at the bottom. And here's the issue I would say that we have. When you think about the S&P 500 and you analyze that, and then you look at sector performance and you analyze those, what you have to remember is the relationship there is the weighting in the indexes, right? So the growthy stuff are huge weights in the index. The biggest sectors that we're dealing with are things like technology and consumer discretionary. So when those are struggling, our growth-oriented benchmarks are going to have a lot of trouble doing well. So we could have that scenario where our major benchmarks are struggling because growth areas of the market are struggling, but certain areas of the market like healthcare and staples, maybe REITs, maybe gold stocks could do actually quite well. It just won't be reflected in the charts of the benchmarks. Let's take a quick commercial break. We'll be back with today's guest, Leslie Jouflas. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is so good to have you join us every weekday after the close. It's such a pleasure to put the show on. We were actually meeting a little earlier today in our new studio, which is on the wall right behind me. We have a lot of really cool plans in the new year to start using that studio pretty often, and we are excited to evolve this show and do a lot of really cool things visually for all of you. A couple quick announcements before we bring on today's guest, Leslie Jouflas. First off, we welcome your questions. We had a great mailbag segment on Tuesday's show. We'll do another one at the end of the week, and we love to feature one of your questions live on the air. You can get your questions to us via email, thefinalbar@stockcharts.com. That's the best way to get in touch with us. On Twitter, we're there at FinalBarSCTV, and we are on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. Hope to answer one of your questions live on the air on Friday's show. Also, go to StockChartsTV.com. We have so many great guests coming through the show. People like Jeff Hirsch, Julius DeKempener, Katie Stockton, Leslie Jouflas, and many others with years of experience and insights to share with you. All of that content is available for free at StockChartsTV.com. Or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Leslie Jouflas. Leslie's the founder of TradingLiveOnline, coming to us from the general area around Redmond. Leslie, it is great to see you. Welcome back to the show.
Well, thank you. Thanks for inviting me, Dave. Thank you. I love being on this show. It's always a lot of fun.
It is, and it's a pleasure to see you. Last time I think I saw you was at ChartCon. It was awesome to have you in the office here and go through a lot of really good discussions together. Let's get to the markets today. We're starting with a pretty long-term chart, a monthly chart of the Dow. Can you talk us through this one, what it's telling you about the markets here?
Yeah, I wanted to give a little bit longer term perspective on where we are, because I think when traders are going through big gyrations up and down, it helps to kind of step back a little bit and take a look at the longer term picture. It's still above this trend line from back in 2009, 2010. However, if we go back and look where that vertical line is on this chart, what I'm showing you on this is where there was a real break of price, and also importantly the RSI broke below an important support area. Well, I've extended that support area of RSI over, and you can see that it's still hovering above it. It hasn't really moved that much off of that support line. So as the Dow, if it comes down and wants to retest where that trend line is, which is also intersecting with a support line, that's a second horizontal line down, that's going to be a really important area of price to test. If it breaks and the RSI breaks that support, my opinion is that we're going to see a larger move to the downside. However, this is a monthly chart, so it may take it a bit, but you can see that on the rally up, that it came right up to that upper resistance area. There was a head and shoulders pattern there. There was a lot of price resistance there. So it did break that shorter term trend line, which a lot of people have been watching. We were watching the S&P to see if it was going to break it just above that 4,100. It didn't quite have enough strength to get through it. On that test, but this was the other chart. This is a chart of the SPY on a daily. So you can see that the market, it just only does a few things, up, down, sideways. And you can sometimes just sort of make a definition of price like I've done with these parallel trend line channels. You can see the price has been forming with these big swings up and down. What I've noticed with these swings is they're very similar in size. The downswings are all very similar in size. The upswings are similar in size. And so this next retracement down with price failing to get above that trend line is going to be very important to watch. I've got a little circle there where there's a gap area close to the 0.50 retracement, which is a well-watched area most of the time. That's right around the 379 level. And below that, you can see, the 618, 786. But if we look at the similarity of the size of the swings to the downside, and we take those swings, we measure them, and we just sort of drop them over and project them down, where I have that lower trend line, the bigger 618 retracement, there's a dashed horizontal line right there. That's it, Dave. And that 618. If it's an equal size downswing, then it's going to be coming in probably right around to that area of support. And so, but first, we just have to monitor what this retracement does. If it finds good support around the 0.50, starts to rally back up towards that trend line, we want to be keeping an eye on that trend line again. Just because it has had some down move doesn't mean it can't make another attempt up there. But so far, the failure of it to get through there is, it makes it a little bit suspect on the upside. And interestingly, the Dow Jones Industrial did get through that trend line. Then the S&P has tried, and the NASDAQ is quite a ways away from it still. So we have these index divergences that are going on. The Dow Jones Industrial has been the strongest the last few months with some really big moves in that index. And the S&P has been next, and then the NASDAQ has been sort of trying to catch up with everybody.
That's two great charts, and I really appreciate you, Leslie, talking through both of those. We have only about 30 seconds left, but I'd love to ask you, we're right now in November into December, we're sort of in that seasonally strongest part of the year. December tends to be pretty strong. January tends to be pretty weak. How does that sort of traditional seasonality fit in with what you're seeing? Is that an input in how you would think about it, or would you prefer to just let the markets tell you what's happening? How do you relate the two?
Well, I always prefer to let the market, the price, to tell me what's happening, and I just like to map out levels to monitor, and then see how price reacts to those levels. And generally, in very strong up markets, generally the 0.382 and the 0.50 retracements should being a four-letter word in trading and market analysis. They should hold. And if they fail to do so, then that's giving you another set of information. So maybe the price gets down to one of those levels and we get a nice bounce off of it, but we still have to see if we can break that 410 level up above. So that's on me watching right now.
I love the focus on the price levels there. Leslie, it is great to see you. Thanks again for coming on the show. Be well there, and we'll talk to you again soon, okay?
Okay, thanks, Dave. Happy holidays, everyone.
You as well, Leslie. That's Leslie Jouflas. Leslie's the founder of Trading Live Online. She's here in the Seattle area, coming to us from her home. And I love that discussion. I always suggest to people to think about a line in the sand, right? What's that level? What's that point? What line can you draw on the chart below which or above which you agree to take action? I think she laid out some really important levels to think about for the SPYs, and on a long-term basis with the Dow, right? That is not something that is just for short-term trading. It also is something that I think is applicable on multiple time frames. So it was very funny when we were prepping for the show and talking ahead of time. I commented to Leslie, "You're bringing a monthly chart, which is a little out of character. That's way longer term, but helps me think." Someone like Leslie, who I think of as more short-term oriented, let's remember that she started with a big picture, long-term chart. I think that's a great lesson of how to approach this market. Keep your eye focused on the long term and then focus on the short-term dynamics as well. Great. A lot of great lessons in there from Leslie Jouflas. Let's continue on our show today with our next segment, Banking on Breadth. What we like to do occasionally is check in on some of the major breadth indicators, what they might be telling us about the market environment. I'm going to bring up my breadth chart list. As a reminder, if you're a StockCharts member, you can access this chart list along with pretty much most of the other charts, if not all of them, that I show on the show. If you go to your dashboard at the top, Go below all of your chart lists. You'll see a little gray button that says Manage Chart Packs. And if you click on that, you can bring up I think it's called David Keller's Morning Coffee Routine. And if you bring that up, this chart list that I'll be referring to, along with a lot of the other ones I share on the show, will be added to your StockCharts account. I'm going to talk through a couple of these. We'll start with breadth on the S&P 500. I haven't brought up this chart a lot yet because honestly, it's kind of not really giving me any real additional info, I guess, than what I'm seeing from other breadth indicators. And it's funny. Some indicators I find I always use in any environment. Certain indicators, they seem kind of topical, right? There's a timeliness where there's a pattern or a signal, and it feels like that chart is kind of the chart, right? That's the one you want to focus on. But then things change, and all of a sudden, it's not really adding a ton of data. So this is one I haven't referred to a lot because it's kind of neutral, right? I have it shaded neutral orange. I'm looking at the advanced decline lines on the major market averages, and it's actually the New York Stock Exchange, and then large cap, mid cap, small cap indexes. The reason why I'm looking at all these is sometimes you will get disagreement. You'll get some divergence where some of these are doing one thing, some of these are doing another. I find the most important signals are when they are making new swing highs or new swing lows, which is why we talked about them a lot in September and October when they were breaking down. What is interesting is that was actually going into the low, right? The October low saw these advanced decline lines all making a new 52-week low of their own. From there, we actually rotated higher. Now, all of these are above their 50-day moving average. As I'm looking at the market rolling over now, and again, the question I would say is, thinking about what Leslie just showed us on her chart of the S&P is whether the major benchmarks can get above those trend lines off of the 2022 highs. I would speculate probably not. I would say more likely that we don't get above those and that we have a bit of backing and filling here, but I could certainly be wrong. What would confirm that I feel pretty that I'm sort of right in that thesis would be these advanced decline lines getting below their 50-day moving average. I think that would be one data point that would tell you there's enough of a deterioration, not just in the major benchmarks, but in the stocks that comprise those benchmarks, because these breadth indicators are all about participation. So at this point, I would say still neutral. I would consider them bullish if they get above the August highs, and I would consider them bearish if they get below the October lows. Right now, we're sort of in that uncharted territory, pun intended, between those two extremes. The next chart I wanted to bring up was the stocks above their key moving averages. Now, we refer to this chart pretty often recently, and this is one that I certainly have been referring to. The S&P 500 notably attempted to get above its 200-day moving average, breaking briefly above last week and getting to 4,100, but then turning right back lower and getting back below the 200-day moving average. So all of a sudden is looking a lot more similar to mid-August than it seemed at first blush when we all of a sudden just blew right through the 200-day. We stalled and now have come back below it just like we did in August. Now, what's interesting is as the S&P is back below its 200-day, most S&P stocks still are above their 200-day. Now, it's only 56%, but it's still over half. If this can hold 50%, then I would say this might be just a short-term pullback before we resume what you might expect given the seasonal tendencies in December. December tends to be pretty good. We have what's called the Santa Claus rally, which usually happens here going into the new year. But if this gets below 50%, if the stocks above their 50-day moving average gets below 50%, that would be a major league warning sign from this chart. So not yet, but I think some clear levels to pay attention to. This is one I want to focus on here because I would argue it's given a pretty decent sell signal today. This is the bullish percent index on the S&P 500. We've talked about this chart before. And as a reminder, if you missed our conversations, this is looking at 500 point and figure charts, all the S&P 500 members, although we have bullish percent indexes for other groups of stocks as well, like the NASDAQ, and other sectors as well. But this is looking at the broad S&P 500. What percent of them have most recently given a buy signal on their point and figure charts versus, the other option would be a sell signal. And currently, it had gotten up to around 78%. That was about a week ago, early December. We were up to 78% of the S&P charts on a buy signal. That's come down to around 68%. Now, the reason why that's important is because when it gets back below 70%, that negates what's called a bull confirmed pattern. The way that I have learned to use this index is when it gets above 70%, that sort of confirms the bullish tape. That confirms the fact that most stocks in this group or in this universe are in a buy signal on their point and figure charts. It's a very simplistic trend following measure of strength. When it gets back below 70%, like it did in early January, like it did in early April, like it did in late August, and like it is done now, those previous 3 times in 2022, that has been a sign of a confirmed market top. We had the sell-off after that in January, the sell-off after that in April, May, and June, the sell-off August, September into the October low, and arguably we've seen that same pattern. Now, we had a bit of a head fake there right around the Thanksgiving holiday. I would blame that on a number of things, lighter volume, Thanksgiving, all of that. But I came back from the holiday, and all of a sudden, instead of going below 70%, it was right back above it and made a new swing high. Now, I think once again, we've gotten a confirmed sell signal like we've had 3 previous times in 2022. The other 3 times have led to the next leg downwards. I'm concerned about the possibility, or maybe the probability, that that is what we might see. What we might see going forward. If that gets back above 70%, by the way, I think that would negate the bearish theme here and make it a little less negative. Another one to highlight is the McClellan oscillator. Now, the summary on this is Tom McClellan, who is a prominent analyst and writes a column on our StockCharts platform and the articles page. His parents, Sherman and Marion McClellan, created this indicator called the McClellan oscillator. It is a way of smoothing out the raw advanced decline data, and it's a good signal of overall momentum. When this is above 0, conditions are bullish. When it is below 0, which has just happened again this week, it's more bearish. So some of these breadth indicators that had been bullish now turning negative. 2 of them just in the last 24 hours have gone from bullish signal to bearish signal. The more of those that tend to build up, the less and less optimistic I'm going to be about the S&P's ability to power above 4,100, power above that trendline resistance, and push back toward the August highs. That is it for the show. We need to wrap it up and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. In our segment Banking on Breadth, we talk about the bullish percent index. And as a reminder, we do that on the S&P. We do it on the NASDAQ 100, which is another version you can look at as well. In some cases, they tend to move in a very similar fashion. Other times, they tend to be a little different. And I think this is one of those. Leslie Jouflas, my guest today, talked about the dispersion between the Dow and the NASDAQ and the S&P. They're diverging in a lot of ways here, with the Dow showing a little bit of renewed strength. The S&P's bullish percent index getting back below 70 is a bearish signal. As long as we remain below 70, those are not bullish conditions for the major averages. If and when it would get back above 70%, that would reinitiate a bullish confirmed signal. It would probably signal an all clear to move above 4,100, I would assume. Chart number 2 is the healthcare sector. Healthcare was the top performing sector in the S&P, not having a great day. I mean, up about, I think, 0.8 or 0.9%, but overall, certainly the top performer out of the 11 S&P sectors today. Wanted to highlight the resistance level that the healthcare sector is facing. If you look at the XLV, you can see the high from the end of last year. You can see it was retested in April, and you can see that's the level that was once again retested in the last week. RSI was overbought. The last 2 times that the RSI was overbought was at the April peak and at the December peak. So this time is different. The way that would play out is if we power above 140, we'll call it 142, which would get us above the April high. If that happens, if you see sustained strong momentum, you would most likely see the relative strength continue to push to the upside. Having said that, overall, I'd like to be in things that are outperforming the S&P, and over the last 12 months, healthcare certainly fits that description. Finally, looking at the healthcare sectors, there are a lot of stocks in the healthcare sector with a scooter ranking above 90. You can use our scanning engine to find those names. And I have a scan that I use all the time that says, let me look at this particular sector or particular industry group in this market cap range and show me stocks with a scooter ranking above 90 or above 80. And all that means it's one of the top performers relative to whatever scooter universe, whatever equity universe you're looking at. If you look at ABBV in particular, over June, July, August, September, October, November, we were in sort of a basing pattern. And a basing pattern is where you have a fairly consistent resistance level around 154, fairly consistent support level around 133 for ABBV. Look at how often it bounced below or bounced around these levels, finding resistance at the upper boundary, support at the lower boundary. That changed here about a month ago, right? In mid-November, all of a sudden we broke out of that range. Now we're approaching all-time highs around 170 for ABBV. Strong charts tend to get stronger. ABBV with the breakout recently, pretty constructive. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close. Special thank you to Leslie Jouflas from TradingLiveOnline joining us on the show today. All of our previous interviews can be found at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.